I think that basically, if you look at Russia right now, Russia has 16% of their $640 billion of reserves in dollars. They have 32% in euros. So they have almost 50% of their reserves in currencies that are controlled by people who want to do them harm. Now, I think we should do them harm. But the point is, from Russia's point of view, that's not a great position to be in. They have 22% in gold, and that's the only part of their reserves which other countries can't control. So I think if you're a country out there that is a non-reserve currency, there's about 100 of them, you might think about saying, you know what, maybe we should have something else out there that other countries cannot harm us with, and that is impervious to inflation or to being manufactured in greater quantities. And so I think it's very bullish for Bitcoin particularly. The rest of crypto is different. I think Bitcoin is unique, and the rest of crypto should be considered as a sort of venture investments, because they're all trying to solve other problems. Yeah, there's emerging opportunities in the market. We're at the beginning, early stages of a regime change. So from a Fed easing, accommodative bond buying set of policies to one that's the opposite. So draining the Fed balance sheet or down. Raising interest rates, and that raises the possibility that they can make a mistake. I mean, they're not flawless, obviously, and so you've got what's happening with volatility is you're getting some probability of a mistake, of recession priced in, and that's I think something that you're going to have to live with for a while until it's clear that doesn't happen.
Yeah, so are you in the recession camp? You know, we are all watching the yield curve. We all have memories of the past decade when the Fed tightened too quickly and had to keep undoing that. So do you think investors should be braced for that possibility, or do you think that it's not going to happen, it's just creating some entry points?
You know, I mean, one of the things that we try and do is try and not make forecasts about what's going to happen, just try to understand what is happening. So what is happening is the Fed is signaling a tighter monetary policy. What is happening is the economy is very strong, unemployment's low, earnings for many companies are at records. State tax receipts are rising way above expectations. Credit card usage is high. And so all of those things, the stimulus is tremendous. So all those things say that the economy is strong and a recession is not on the horizon. Doesn't mean it can't appear, but that's what's going on now, and we're trying to invest in this particular environment, and not one that we really can't forecast. Well, real rates are still sharply negative, and especially if you just use headline inflation. So I don't think the bond market is attractive at all. I think the Fed wants to tighten. They would probably like to see the curve steepen moderately, and we just don't see any value in bonds here.
One more question on that. Do you have a point of view on whether it'd be better for them to run down the balance sheet? Some say maybe that would help long end rates go up. It would unflatten the curve, but who knows, right? Or would you prefer to see more rate hikes, 50 basis point rate hikes? Anything there that you're watching?
You know, we've been kind of wondering why they're still buying mortgage-backed securities into this kind of a housing market. So I think both of those things in moderation make sense. So letting the balance sheet drain off of some of the securities that they own, as well as moderate tightening. They're signaling very strongly that they're not going to try and tighten too much. They're going to be sensitive to a recession. Doesn't mean they'll get it right, but I think they're looking at the right thing.
Here was your dip when the invasion started, right? And what I had done that night is I put out limit orders because it occurred. I figured it could occur while I was sleeping. I wouldn't be able to react. So I put out a limit order to buy Bitcoin, Polkadot, Solana, even some more Cardano. And sure enough, they got hit, which was beautiful. And I was anticipating the same thing. You anticipate an overreaction, the panic. We've seen panic before, how it crushes assets, risk assets initially. And then what you see is them bouncing back. So that's exactly what I did. You did the right thing. In fact, the next morning, I had GLD, which is gold, the gold ETF, and I actually unloaded it on the gap up at the highs because I also expected it to come back down. And again, these are extremes. So you always want to go counter kind of trend or counter thought process. And that's exactly what you did there. And that was 100% correct. So go counter trend and you'll usually be right. And in terms of Bitcoin, what we're seeing here is a beautiful pop today. My feeling on it is that you've now got more sanctions with SWIFT being introduced or taken away from some of the Russian banks. This is becoming a longer drawn out conflict, more sanctions on Russian oligarchs. And that's going to make people more intrigued about, okay, well, does Russian oligarchs, do they start buying Bitcoin? Do they diversify out of rubles and out of currencies where they can actually move those Bitcoin assets to different locations and access them still. And then you also have the plight of the Ukrainians, where it's hard to get out of the country with suitcases full of money, but it's a lot easier to go somewhere else, access your Bitcoin as well. So I think you're seeing a little bit of that vibe of, okay, Bitcoin makes a lot of sense when there's geopolitical risk out there. I think it is. I mean, again, my long-term thesis for Bitcoin is bullish. Yes, I do believe eventually we will see another leg down to 20,000. My very short term, as I mentioned, I bought some Bitcoin on that dip. So very short term, I think there could be a little bit more upside. But per the chart, I'm looking at an upside that could be capped around 42,000. That's my first kind of resistance. We're getting very, very close. And then if we get through 42,000, you have this upsloping trend line. You can see how it hit it right here. If we come back to it, it's around 47,000. That would be your next resistance. If it somehow can push through 47, then you're talking about 52,000 as being your next likely target. Now, again, this is all short-term movement. We're inside of a bigger bear cycle, in my opinion. So eventually we will see the Fed tightening more. And I think, by the way, that's part of it, right? So, as horrendous as the invasion is and people getting hurt, there's a chance for the equity markets to say, okay, the Federal Reserve may not raise 50 basis points in March because of the geopolitical turmoil. Maybe they're only going to raise 4 or 5 times in 2022 versus, I think, what JP Morgan said a couple of weeks ago, which was 8 or 9 times in 2022. So you've seen this little bit of a situation where tech stocks have actually been doing a little bit better since the invasion. And I think it has a lot to do with the chance that the Fed is not as aggressive on tightening. Yeah, so I mean, 42 is going to be your first, small test. It's only a minor level of resistance here on the chart. So again, small test coming up at 42,000 may take a couple of days to try to push through it. But I do think that there is a decent chance that it's able to, and then may trade back up to that 47, this upsloping orange trend line here. I think what investors will have to understand is that everything we do here in technical analysis land is based on probabilities, right? So when you see a sharp move down like this, there's inevitably a period where you go sideways and chop for long periods of time. So you can see how you're starting to kind of do this pattern. And ultimately what you're forming is a bigger bearish pattern on the daily chart. It's called a bear flag or an in spirit of bear flag. And so the odds favor that at some point it breaks down. Now, it gives you a lot of opportunity to trade the range, which is what I've been doing. But inevitably, the midterm, I still think sub 20 or 20,000 is likely. And then once we get down there, once you see this kind of final flush out .com-ish type reckoning period, then I'll be starting to hodl myself and starting to accumulate more Bitcoin for the longer term. Yeah, and that's a great question, right? So this can be used for people that have longs like me. If it breaks this next level, I'll show you guys, then I would exit the longs that I have right now and say, okay, game up, game over. And basically it's this trend line, right? So you have a very defined line that you can watch. And the beauty of it is it's actually rising. So your stop is getting tighter and tighter as Bitcoin goes up, almost like a trailing stop in this situation. So if you were to get below this line on a daily closing basis, I would be very concerned that this range is now broken and price will then start trading down pretty aggressively.